Today on the deep dive, we're getting into a really fundamental tension for investors right now. How do you get in on this massive AI revolution, but without, betting the farm on a few super volatile names?
Right. You want the upside, but you need a solid strategy. And we've got a great set of sources here that compare two ETFs, two exchange-traded funds that really represent completely different ways of thinking about this.
Exactly. The conflict is, well, it's perfectly captured in the data we're looking at. In one corner, you have the big established titan. That's the State Street Technology Select Sector SPDR ETF, or XLK.
The old guard, basically.
Yeah.
Riding the wave that's already here.
And in the other corner, you've got the challenger, the Round Hill Generative AI and Technology ETF. The ticker is CHAT. This one is actively managed, and it's just laser focused on finding the future leaders in generative AI.
So the core decision for you, the listener, really boiled down to this. Do you want your tech exposure anchored to today's proven mega cap giants? That's the XLK approach. Or do you believe that a higher fee, actively managed fund can actually find and profit from what's coming next?
The chat premise, essentially, the idea that AI is going to totally reshape the market.
Right.
So that's our mission for this deep dive. We're going to get past the hype and really unpack the differences here. We're talking cost, what's actually inside them, risk, performance, you name it.
The classic passive index tracker versus the specialized high conviction bet on the future.
Let's jump right in with the foundation, the philosophy, and what it means for your wallet.
These two management styles really set the stage for everything else. XLK is your classic index tracker. It's just designed to copy the performance of the S&P 500's tech sector. Holds about 70 stocks.
So it's built for stability and just broad coverage. And chat is the complete opposite of that. It's actively managed. So it's 52 stocks are picked by actual people, by managers who believe these specific companies are going to outperform because of their work in generative AI.
And right away, that means you're putting a lot more faith in their expertise and their bets on the future.
And you pay for that expertise. I mean, when we look at the cost data, the fee difference it's just staggering. XLK, because it's passive, just tracking an index, has an expense ratio of only 0.08%.
It's almost free.
It's practically free access to the whole tech sector.
And this is the immediate hurdle that chat has to clear. Because of that active management, all the research that goes into it, its fee is much, much higher. We're talking 0.75%.
Wow, that's nearly 10 times the cost.
It is. And that 0.75% isn't just a fee. You have to think of it as a performance hurdle. The managers at chat have to beat XLK by, 0.67% every single year just to break even with the passive fund.
That's a huge drag. And then there's just the sheer scale, the size of these funds, which tells you a lot about liquidity. XLK's assets under management, its total size, is just massive. It's $93.46 billion.
It's a behemoth, a cornerstone of the market. Now, you compare that with the challenger, chat, which manages about $1 billion.
Still a lot of money, but not even in the same league.
Not at all. And XLK's size means it has incredibly deep liquidity, tighter trading spreads. It's crucial for big institutions moving serious money.
So this initial data really frames the whole trade-off, doesn't it?
Perfectly. XLK is the established foundation. It's huge, it's liquid, it's dirt cheap. Chat is the price you pay to bet on future disruption. And it needs to work a lot harder just to keep up.
Okay, so we set the price. Now let's pop the hood and see what you actually own, starting with this idea of sector purity. If XLK is just tracking the S&P 500 tech sector, how pure is it? How strict is that definition of tech?
Oh, it's about as pure as you can get. The sources show 99% of XLK's assets are invested directly in technology.
So a very clean, straightforward mandate.
Right. It's aiming for that comprehensive passive coverage of all the big S&P 500 tech names. Simple.
But chat has to be more flexible, right? I mean, if you're chasing an idea like generative AI, it doesn't really respect those neat sector boundaries.
Exactly. It has much less sector purity by design. It allows the managers to reach into these adjacent areas where AI adoption is just starting to take shape.
So what does that look like?
Well, chat is about 83% technology, which is its core. But then it holds 11% in communication services.
Okay, so think social media, content companies. That makes sense.
Right. And then, get this, 6% in consumer cyclicals.
Wait, hold on. Consumer cyclicals? That sounds like retail, hospitality, things that are tied directly to the economy. Why would an AI fund be buying into those areas?
And that's the beauty of active management. That's what you're paying that fee for. These aren't, old school department stores. They're likely companies using generative AI to radically transform their business. Maybe they're building hyper-personalized e-commerce, or they're using huge new AI models to completely overhaul their supply chains. Chat is betting that the AI adoption in those sectors will actually deliver better returns than just owning more legacy tech.
That flexibility is what you're buying. That makes perfect sense. Now, let's look at the actual companies they hold, because this really highlights the inescapable concentration in the market right now.
For sure. XLK's performance is completely dominated by its top three holdings. You're talking Nvidia, Apple, and Microsoft. When those three stocks move, XLK moves with them. Simple as that.
Right. Their earnings are already a huge chunk of the whole index. And Chat, despite its different philosophy, it still relies on those same big infrastructure players.
It does. Its largest holdings are Alphabet, which is GOGL, Nvidia, and Microsoft.
So it basically swaps out Apple for Alphabet.
Which, given Alphabet's dominance in search and AI research, that shows a slightly different strategy. But it's still betting on the massive success of the core AI builders.
That subtle difference is key.
And we should also mention the screening process. Chat explicitly includes an ESG screen.
Environmental, social, and governance.
Right, a filter. And that might appeal to some investors who are looking for that responsible investing angle within the whole AI theme. XLK, of course, avoids that kind of overlay entirely.
So it's another layer of human judgment being applied to the Chat portfolio.
Exactly.
Okay, let's translate all these differences into actual results. This is where the deep dive really happens. Performance and risk. Let's start with risk. Volatility. We can measure that with beta, which tells you how volatile an investment is compared to the S&P 500.
Sure. So XLK, being a focused sector fund, is naturally a bit more volatile than the whole market. It had a beta of 1.26.
Meaning, if the S&P 500 moves up 10%, you'd expect XLK to move up about 12.6%.
Yeah, it's pretty standard for a tech fund.
But Chat is betting on disruption. And disruption. Well, that comes with a lot more variability.
It absolutely does. Chat has a massively higher beta of 1.70. So if the market moves 10%, Chat is expected to move 17%. It just confirms that its active specialized design introduces way more volatility.
Which is exactly what you'd expect when you're chasing a theme like AI across different sectors.
For sure.
But where that volatility really paid off, at least in the short term, was the last 12 months.
This is where Chat's focused approach really flexed its muscles. The one-year return for Chat, as of late 2025, was a massive 44.6%.
44.6, that's huge.
It just screams that their active managers correctly identified the companies that benefited most from the recent AI boom.
And XLK, while it certainly did well with Nvidia and Microsoft, only returned 21.9% in that same period.
So Chat more than doubled the index tracker's return.
That 44.6% is it's a powerful argument for high-fee active management if you only look at 1 year.
But we're doing the deep dive, so we have to zoom out. Because the 5-year view holds the most surprising piece of data in this whole comparison. Despite that massive recent outperformance from Chat, the 5-year growth of a hypothetical $1,000 investment it's shockingly close.
Okay, give me the numbers again.
After 5 years, that $1,000 in Chat grew to $2,243.
Okay.
And in XLK, it grew to $2,243.
Wait a minute. They're basically identical.
Quantitatively identical.
Wow. So over 5 years, the massive difference in fees, that 10 times higher expense ratio, the active management, the higher volatility, it all resulted in basically the same total return.
Yes. That completely undercuts the value proposition of active management, at least over this last cycle.
That parity isn't just surprising, it's a huge data point against the whole idea of high-fee active funds during a major tech boom.
We have to unpack that. What did that 0.75% fee actually buy an investor over those 5 years?
In terms of total return, essentially nothing.
Nothing.
So why didn't it pay off? If Chat is making all these smart strategic bets, why couldn't they pull ahead?
Because the market cycle we've just lived through has been defined by the unstoppable astronomical growth of just a few megacaps. Nvidia, Microsoft, Apple, Alphabet.
The ones that XLK is heavily concentrated in.
Right. And Chat also has to own those big winners for the majority of its assets. So the other bets it took, the diversification into consumer cyclicals, they just weren't strong enough to overcome the massive drag from that higher fee.
It's a great analogy. It's like they had to pay for the Ferrari, but the Tesla index fund got them to the finish line at the exact same time.
That's a phenomenal way to put it.
Okay, so let's touch on the risk profile again. If Chat has that much higher beta, the 1.7 euro, shouldn't its maximum drawdown, its biggest loss, be way worse than XLK's during a downturn?
Logically, yes. You would absolutely expect that. But the data tells a different story.
Yeah.
Chat's maximum drawdown over 5 years was negative 31.34%.
Okay.
XLK's max drawdown was actually a little worse, at negative 33.56%.
So XLK actually experienced slightly deeper losses. What's going on here? Why is the beta so different if the actual pain, the drawdown, is so similar?
It probably comes down to the timing of their sector exposure. XLK, because it's an index, might have been slower to adjust its holdings in certain mega caps that had sharp but brief drops.
It's forced to hold them.
Exactly. Whereas Chat, being actively managed and a bit more diversified, may have had some cushioning around the edges or just managed risk a little better at key moments.
So the takeaway is that when the market tanks, they both get hit hard.
And that pain is highly correlated to the same big stocks they both own.
Okay, let's translate all these numbers into some actionable ideas for you, the investor. This deep dive really shows the core decision is about how you want to structure your portfolio, not just about being excited about AI.
Absolutely. XLK's value proposition is rock solid and cheap. It anchors your exposure to the companies already making almost all the profits in tech.
It's the simple, safe bet on today's titans.
And it guarantees your returns will align with the biggest, most established firms without you having to trust any manager's judgment.
Chat, on the other hand, represents a much more forward-looking position. It's built around the belief that generative AI is going to completely reorganize who the market leaders are.
And that means Chat's performance depends on two big things. First, the manager's ability to actually pick those next winners.
And second,
how quickly all this AI spending actually turns into durable profits for those 52 companies, especially the ones outside of pure tech.
right. If a new AI leader emerges from outside the current top three, Chat is structurally designed to capture that. XLK might be much slower to react.
And if we connect this to the bigger picture, the distinction is really whether you want returns aligned with today's market structure, cheap, massive, liquid, or you want exposure designed to follow where that AI-driven value might pop up next.
Which is flexible, high conviction, and expensive.
And the great irony we found is that the active, high-fee fund completely failed to beat the passive giant over a 5-year boom cycle. It's just a powerful lesson in how hard it is to generate alpha when a few names dominate everything.
So let's wrap this deep dive with the key takeaways. We saw massive differences in cost and size. XLK is almost 100 times larger and 10 times cheaper. And yet, over the medium term, their total returns and their maximum drawdowns were surprisingly similar.
This whole discussion about Chat and XLK just shows that even when you're targeting the same disruptive trend, like AI, the vehicle you choose really dictates the outcome.
Chat gives you flexibility, that ESG screen, and the potential to capture what's next.
And XLK gives you cost efficiency and direct exposure to proven winners.
So here's the final provocative thought for you, the investor. Given that Chat is reaching into sectors like consumer cyclicals, you have to ask yourself this. If XLK continues to rely almost purely on Microsoft and Nvidia for the next 5 years, is its index approach actually exposing you to a hidden risk? The risk of completely missing the value that's emerging in all of these other newly transformed sectors, no matter how expensive Chat is today.
Until next time, consider the cost of omission.
Keep digging.